Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will discuss the balance sheet within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are within QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to talk about some of the major forms, some of the major financial statements, this time being the balance sheet. In order to do so, we're going to go down to the reports on the left side. Most of the reports that are frequently used will be here in the frequently used section, including what is the balance sheet and the profit and loss, considering the fact that they will probably be the ones most used and most run. We can also look at the reports under the recommended tab, which will also generally include the balance sheet report. If any report isn't there, we can also tab over here into the search area, or select here in the search area and select the balance sheet, or type in balance sheet, and it should auto-populate so that we find the balance sheet. So we're going to just run the standard here, the standard balance sheet. Then we have the information. Now, if we haven't started any data here, then we're not going to have any data within the balance sheet. But we do want to go through this. So this is really going to be the data at the end of our problem that we're going to look through. First here, I'm going to show you at least first, and then we'll go through the problem and actually input this data. And then we'll basically be running forms again as we go. So this is going to basically be the endpoint, our balance sheet, our forms, our completed products. And then we're going to enter the data, and then we're going to get back to this endpoint again within this information. Note, if you're working from a new company, that will of course be the process. If you're working at a company that is continuing, or if you get a new job at some place and you become the new bookkeeper, then clearly there will be data typically that's already there. So we will go through the starting of a company, the entering of the first month, and then the entering of the second month, where we'll have beginning numbers and the second month numbers. In any case, we're going to be working here with the dates of 01/01/21 to 02/28/21. That's January 1st, 2021 to February 28th, 2021. We are working a problem in the future. That's kind of like the way these types of problems have to work. We can't usually work in real time because we're typically trying to enter all this data as of a point in time. So in practice, of course, everything would be run as of the current date. In a lot of problems when we're practicing, we're going to have to be very careful of those dates because we're not working currently in the current date. We are then going to run that report. So here we go, running that report here, and that'll give us the balance sheet. Now, we're going to go through the components of a balance sheet fairly quickly and then see how the QuickBooks is in conformity, how they format their balance sheet, and how they differ then in a little bit in terms of their financial statements, in terms of their balance sheet, from what we may have learned in practice in standard accounting type theory class. First thing is, you may have saw that is unusual for a balance sheet, is we enter two dates. And as you can see down here, it says as of February 28th, 2021. When we learn about a balance sheet just from a theory standpoint, we know that it's as of a point in time rather than a date range, rather than having a beginning date and an ending date. So that is represented correctly here, but why would we need the beginning date and the ending date? There's a couple different reasons. One is that we're going to use the auto zoom feature, and as we do that, when we click on this information, it'll actually give us some detail, what we would call in a theory class kind of like a general ledger type account for the checking account. In this case, we're going to call it a transaction report in QuickBooks, and that'll give us a date range. If we didn't put a date range, if we just put one date here, it would just give us one date of a general ledger. By having two dates, we can then click on this item and it'll automatically go to giving us 2 full months in this case, or date range of data for transactions in a general ledger type report, transaction detail report, as it's called in QuickBooks. If we scroll down to the bottom to the equity section, we'll also notice a slight difference down here in that we have some more timing accounts down here. We've got the net income here, and we have the owner's draws and investments. From a theory standpoint, we may have learned that whether we are a sole proprietor, we'd be breaking these out, whether we're a sole proprietor, a partnership, or a corporation, whatever the type of entity, we typically break out the income, the net income on the income statement, and then the statement of retained earnings or the statement of equity. And then we don't have then the net income on the balance sheet oftentimes. It's just going to be included, in this case, in retained earnings or in the total capital account. And the same is true for owner pay for personal expenses. That could be called draws for a sole proprietor. For a corporation, it would be more in the terms of dividends and would be found on the statement of equity or the statement of retained earnings, not typically on the equity section of the balance sheet. So we have some more detail on the balance sheet, and that detail then reflects a timing statement, meaning the net income has to be over a certain time period. And if we do not, typically QuickBooks will select the time period as the year to date. So if we're a December 31st year end and we selected February as the month we're working with, then it would have net income for January and February, that time period. So that's another little bit of a difference within QuickBooks. Now, if we scroll back up, of course, the three components of the balance sheet just always will be, whether we're talking theory or QuickBooks, will be assets, liabilities, and equity. And the balancing will be assets equaling liabilities and equity. And we could see this if we start looking at these little arrows here that will crunch the numbers up. So if I select this arrow, in other words, we'll see that it now just has total assets. If we say that we want to have the liabilities and equities and we select that arrow, then it'll change from that little triangle to the triangle going this way. And now this is our accounting equation in its simplest form. This is the balance sheet in balance. It's got the total assets equaling the liabilities and equity. So let's open this up just piece by piece and break this balance sheet down so that we understand all of its components. And so if we select this triangle, we're going to open this back up. And I'm going to close down as much as we can. Again, I'm going to close down the current and we'll close down the fixed assets. So you can see the next component within assets, the next subcomponent will be current assets and fixed assets. That's the two components we currently have. We might have current and long-term assets or non-current assets and fixed assets, but we may not have any non-current assets that aren't fixed assets now. So these are the major two categories we will have. If we open up the current assets, then we have within the current assets, let's close these up. We've got the subcategories of the bank accounts, accounts receivable type accounts, and other current assets. So again, I just opened up current assets and then closed all the sub accounts within there. Within the bank accounts, this is the most liquid current asset, and that's going to give us the checking account, of course. And if we were to export this, or if you learn this in a theory class, it wouldn't typically be called bank account or checking account. It would be called cash, and it would include, all cash type items, whether they be savings account or checking account. Within QuickBooks, if we have multiple cash accounts or multiple checking accounts, we will typically list them out here, even on the balance sheet. If we were to make financial statements, then we would typically combine those together and put them under basically a cash. That would be the general format. So then if we go down to accounts receivable, another current asset, and we select the triangle, then we have the accounts receivable standalone account here. We typically have one accounts receivable account. It's a special account because it needs a subsidiary ledger that tracks this. This is who owes us money. And it'll track who owes us money here if we select this item by transaction, by the general ledger or transaction detail. We also need that information by customer who owes us money. And so that's why this is a bit of a special kind of account. It has that special need, that special tracking need. And then we have other current assets if we select that item. We have the inventory, we've got prepaid insurance, short-term investments, and undeposited funds. We'll go over more of those items, what they are, as we construct our financial statements and enter data. I won't go into each one of those, but that gives us the total current assets, the fairly liquid assets, the assets that will be consumed fairly soon in order to help us generate revenue. We then have the fixed assets. And if we select now, fixed assets could be termed property, plant, and equipment. Sometimes they're referred as depreciable assets. They're going to be more long-lived assets, assets that typically we buy, we hold on to, we use them for a long period of time in order to help us generate revenue. Things like cars, forklifts, equipment, building. Land is included as well, even though land will not be something that we typically depreciate over time. It's something that pretty much stays around. In a human lifetime, it'll still be here. So we've got furniture and fixture, and then we've got the depreciation, which is really accumulated depreciation here. And so we'll talk more about that as we go. And that gives us our total fixed assets. Notice the accumulated depreciation is going to be a negative number. And we have the furniture and fixture here and the original cost. And so we're subtracting out the accumulated depreciation to give us the net amount. That then gives us the total assets, which will be the current assets, plus the fixed assets gives us the total assets. So let's close up the assets again. We'll close that side up. Now the other side is of course equal to it. The assets represent what the company has. The liabilities and equity represent who has claim to what the company has. In other words, we're going to reformat who the company has, not listing out the things the company has, but who has claim to those things that the company has. Either a third party, liabilities, or the owner, equity. So if we select this little triangle, and then I'm going to make this as small as possible. Here's our subcategories here. We've got liabilities and equity. We're first going to talk about liabilities. So we'll go into the liabilities. This represents, of course, third-party claims. So this is what the company has. $79,181 of it is claimed not by the owner. The owner wouldn't get it. In other words, if we closed the company, if we sold all of our assets and we got exactly that amount for it, which we may not because we don't know what we would sell, for example, the property and equipment for, even though it's on the books for what it's on the books for. But if we got that in cash, we would typically have to pay this to somebody else, and then we'd get to walk away from our business with the equity amount here. So the equity is kind of the book value of the company. Notice that the total liabilities and equity doesn't tell us anything other than we're in balance, other than it equals total assets. What the key number is that tells us what the company is worth on the balance sheet as of a point in time is the equity number. That represents assets minus liabilities. And that's what we, in theory, would walk away with if we were to sell all assets, pay off all liabilities. Then we're going to open up our liabilities, third party that we owe. We've got current liabilities. I'm going to make these smaller. And those include the accounts payable account. That's going to be stuff that we owe on the short term. So we bought something for a short term and owe it back within like 30 to 60 days. We've got the credit card, which is another type of liability. And then we've got the other current liabilities, which are going to include sales tax, interest payable, loan payable, and payroll taxes, unearned revenue. We will go over these more in a later point as we enter the data. We then have the total current liabilities and then long-term liabilities. Long-term liabilities are different in that they're not due for over a year's period of time. It's just an arbitrary number. So we basically say, hey, of the stuff that we owe to other people, how much of it is coming due soon? And that due soon to us is going to be a year, and we'll put that in the current liabilities. We're more concerned with that because we're going to have to pay that pretty soon, most likely with some type of current asset in order to pay that. And then we've got the long-term liabilities, which are a concern, but they're a little bit later. We can wait on that. We have some time to build up some money, hopefully, before those become due. So that's going to be the liabilities. That gives us the total liabilities, which will equal the current liabilities and the long-term liabilities. If we close that back up, then we can see the equity side. We close up the liabilities, and we see just the equity now. So now I'm going to open up the equity. And that gives us a lot of different information, which again, we may think is a little bit different than we might see on a standard financial statement for financial accounting theory textbook type problem. And that first we have opening balance equity, which we would never see in a theory problem. It's what QuickBooks uses in order to help force something to work when we do something kind of unusual. For example, when we start a new company, we will use the opening balance equity, not on purpose, but we will put the information in the system as QuickBooks recommends us to do. And then QuickBooks will use this as the default account. It's QuickBooks' way of trying to get around knowing debits and credits, trying to be able to input the data into the system without using debits and credits, without using a balancing process and QuickBooks then forcing the balancing process by creating an opening balance equity. We then moved it out of the opening balance equity, and we'll show how to do that, how to set up a company and remove it from opening balance equity. If there's anything in opening balance equity, it's not necessarily wrong because it's part of the equity section, but it's not exactly right either because there's no real account called opening balance equity, and it could make people think that if someone sees something in opening balance equity, they're probably going to think that the financials are not correct. And then we've got the owner's investment. That represents what the owner put into the company. Oftentimes in theory problems, that will be combined in the capital account, or in this case in retained earnings. In this case, they're breaking it out in a similar way as breaking out draws. Then we've got the owner's pay and personal expenses. That's kind of like the draws account for a sole proprietor. It'll be similar to a dividend for a corporation. Again, these two accounts would probably be seen on a theory problem, not on the equity section of the balance sheet, but on the statement of owner's equity or the statement of retained earnings. Then we've got the retained earnings, which again, if it was a sole proprietor, it would probably be called a capital account, owner capital. If it's a corporation, that's usually the term of retained earnings. So for QuickBooks Online is basically using owner's investment, which sounds like a sole proprietor term. This is a sole proprietor here. And then it uses the owner's pay for personal expenses, which sounds like draws, which is more of a sole proprietor term, which dividends would be a corporation term. And then it uses the term here, retained earnings, which sounds more like a corporation term, a capital account would sound more like a sole proprietor term. So the equity section terminology is a little different, but in the whole, the thing is all the same. Then we have, of course, the net income, which again would typically be on the income statement and not included in the balance sheet. And then we've got the total equity. So if we were talking about a sole proprietor here, normally the difference between this balance sheet and kind of a normal balance sheet is that we would only have this one number, and if it was a sole proprietor, it would probably be just under an account, kind of like retained earnings, but the capital account, we call it capital, typically for a sole proprietor. But the total is the same. So it's trying to give us some more links. It's trying to say, hey, this balance sheet is linked to the income statement, trying to tell us how they're related, forcing us to see how they're related. It's trying to break out, hey, look, this is the owner pay, and this is the owner investment. These are the components of equity that are not net income. And so I think QuickBooks' goal here is to help small businesses or to help people that may not be looking at financials all this time to see how the two main financial statements are related on this statement, and to see the breakout of what is included in equity, which is not part of net income. So those are going to be the major components. I'm going to make this a little bit large again. We'll make this large, and we'll see all of the components here. Note that this is going to be the end statement, and as we've seen before, what we really are going to do when we start entering data is get to the end statement and then use the auto zoom feature to see the activity. And that's just going to be a common practice. I recommend doing it pretty much every time you enter anything. Enter something, make a bill, make an invoice, make a sales receipt, and then go to the financial statements, the balance sheet and the income statement, and see what happened by selecting the date range and then selecting this item or any item that you believe is going to be involved. There will be at least two accounts affected. So if we select this, it'll zoom in, it'll give us our detail. This is what you might call in theory a general ledger report. QuickBooks calls it a transaction report. So, and you might call it a transaction by by date report. It really kind of depends on the software name. Note now that it really depends who you're talking to and what things are going to be called. If you're talking to someone who's a theory person who does accounting theory, this will in essence be a general ledger type account. If you're dealing with a bookkeeper that deals primarily with QuickBooks, this is going to be a transaction report. And if you deal with both, which most people probably will, it'd be best to know both terminologies. If someone asks you for a general ledger, this is really the kind of thing they're looking for. This is the detail. This gives the detail by date. And it gives actually more information than that because it gives you the transaction type. If you're dealing with someone that asks for a transaction detailed report and you're working somewhere else, it's similar to a general ledger. So what we have here is we're going to have the transactions by date that are affecting cash. It also gives us the transaction type, which is really nice. It's a deposit or a check or an expense. It gives us the number if we have it, account numbers or check numbers, the name if we have a customer or vendor, a memo if we were nice enough to write one, the account and the split account. It tells us what other accounts is affected. There will be at least one other account each time. And it gives us the amount and a running balance. The running balance here, we can always see what the balance is. Here's the activity, here's the balance. It started at 25,000, minus 12,000 to 13,000, minus 16,000 to negative 3,000, plus 65,000 to 62,000. So that's how it's going to roll through. If we select any of these items, it'll go right back down to that data input detail, and we'll get to see what actually happened. This is the form. This is what someone actually input in order to generate this information. So I'm going to close this back out and go back to this report. That's going to be really useful to go back and forth, and it's something that we don't see in the theory classes because it's a lot more difficult for us to go, we're usually constructing, and if we're doing it by hand from the actual transaction to creating the financial statements, we often don't get to see the other side of things. If you work with software, you're always looking at the other side. You're trying to see what happened to the financial statements, and you have that ability to quickly go back. So we'll go back to the summary. That kind of quick zoom is available for all of the accounts here. So we can do that for any of the accounts. If we go down to accounts payable, for example, and we select any number here, we'll see that same detail by date. We got bills and the payments of the bills in this case. We've got the amounts, and if we select any of these items, for example, this bill, we will then see the data input form. Note that most of the stuff will have a data input form related to it. I'm going to close this back out. We'll go back to the balance sheet. Now we've taken two accounts that are normal transaction type accounts. If we looked at something like furniture and fixture, which we don't buy furniture and fixture that much, so there's not going to be a lot of activity compared to, of course, the cash account or the AR account, accounts receivable, the accounts payable account. If we select the furniture and fixture account, then you'll notice there's a lot less activity. And so all we have is a check here, and then we've got a journal entry down here. We paid these with cash, so we were able to write a check. This is more of an unusual transaction. This, we bought furniture and we financed the whole thing. And so there was no cash affected, and there's no form. Notice we just had to use a journal entry in this case. We'll actually use some registers for something like this, but QuickBooks, when there's no form, even if we use the register, will default to a journal entry. So this is where we will see the debits and credits directly, and there's not really any way around the debits and credits here. If you're concerned about the debits and credits and you want to learn about the debits and credits, because QuickBooks is using debits and credits, you can go to the trial balance report and see this same activity and see all the accounts in one space and see how they're being affected with debits and credits. So I'm going to close this back up. We're going to go back to the balance sheet, and that's going to be the major components of the balance sheet. Hello, in this presentation we will take a look at the balance sheet within QuickBooks Pro 2018. If you've been following along, we will be continuing with the Get Great Guitars problem. If not, that's okay. We're going to take a look at a balance sheet, discuss what a balance sheet is, and go through the components of the balance sheet. If you have the backup file, you can restore the backup file as demonstrated in a prior presentation by going to the File tab and restoring. We currently have the Open Windows list open over here. In order to open that, you can go to the View tab and open Windows list there. And we have the company home page open, the company home page found at Company and Home Page on the drop-down first item. This is going to be our starting point every time when we go into the QuickBooks program, and we this time are going to be looking at one of those fundamental core financial statements, that being the balance sheet. The balance sheet will be found under the reports, although it's often called the financial statement. So this, although it will be a report, it's really the main report. It's going to be our financial statement report. It's the end results, the product that we're going to be making. When we enter all that data, it's the thing we're going to be using in order to make decision making. It's the thing that's going to be wanted, or one of them, when we get any kind of loan or present our information to a creditor, to the tax preparers, and whatnot. So we're going to select this report, by the way, to the tax preparers. They're definitely going to want the profit and loss. They may or may not want the balance sheet, although they're tied together in some ways, as we will see. So we're going to go to Company and Financial, and then we're going to scroll down to the Balance Sheet Standard. Balance Sheet Standard. That's going to be the one. Now I'm going to change the report by changing the date range up here. Instead of just the point in time, we'll talk about why there is only one point in time, but we'll go to the Customized Report first, changing the date range, that date range being from 01/01/21, January 1st, 2021 to 12/31/21, December 31st, 2021. We're going to select OK, and here is our report. So this is going to be the standard balance sheet. We're always going to be going back to this. We're always going to have it open, or we'll have it open oftentimes when working through the problems within the Open Windows list, because everything we do on the Home tab, we really want to check where it's going to be affecting oftentimes the balance sheet. Almost all the time when we select something on the Home tab, it's doing something to some balance sheet account. The balance sheet account is our double entry accounting system, in that if we think about the accounting equation of assets equal liabilities plus equity, that is the balance sheet. We have the assets, we have the liabilities, and we have the equity. So this is the statement. We want to have some idea of how to read. We want to have the format of it. We want to be able to go back and forth from the data input to the balance sheet. So we'll go over just some basic components, what a balance sheet is and what are the components of it. How can we maneuver around this balance sheet? Then we'll talk about some other items in terms of using the balance sheets and features and customizations to it in a future presentation. The typical balance sheet only has the one date here. In a lot of other forms, we will have a date range, a beginning and an end. Here we see the normal balance sheet title, which is as of December 31st, 2021. What it does not say is for the year ended or the month ended, and that's because really it is only as of a specific point in time. So when we go to the end of the year, if we're getting our balance sheet ready to take to our tax preparers or whatnot, then note the income statement is reporting what's happening over time. The balance sheet, however, really doesn't need a time frame. It doesn't need. We don't need to know the fact that at this December 31st, 2021 is what we want to be as part of our reporting package for the year of January 1st through December 31st, 2021. This same point in time would be the same if we were just reporting the balance sheet as of the day or the week ended December 31st, 2021. This is a point in time report, reporting where we stand at this point in time. And there's really, in essence, there's nothing we can do about it at this point in time. This is where we are at. If we want to know how we got to this point, then we have to look at some other reports, some timing reports, the main one being the income statement, which QuickBooks calls the profit and loss. If we go through the balance sheet, it is, again, our accounting equation. So if I compress the components, it's assets and liabilities and equity. There's our accounting equation. And you can compress the components by hitting this or selecting this little triangle. And so we're going to make it large again. We're going to go assets equal liabilities plus equity. That's our entire balance sheet. Then we break the assets down into current assets. Our most typical current assets are going to be our checking account assets. And here we only have one checking account. That's our cash account. That's our main account on the balance sheet, probably the first account we think of when thinking of the balance sheet. And it is as of a point in time, meaning this is what we have in cash as of this point in time. We don't need a date range in order to do that. We can basically check here if that's what we got at this point in time. That's what should be in the bank. Of course, there will be outstanding checks and deposits, and we'll have to reconcile it. But in essence, that's what we have. And then we'll have the receivables. That's going to be what people owe us as of this point in time. We've got the other current assets. These are going to be other assets that are really close to cash or relatively close to cash, convertible to cash within a year's time period, or will be consumed at least within a year's time period. And so we've got the inventory, prepaid insurance, undeposited funds. We'll talk more about those particular accounts as we go. And then we've got the fixed assets, our long-term assets, also depreciable assets, could be called property, plant, and equipment as well. We have the furniture and equipment here. And then we've got the contra asset accumulated depreciation related to the furniture and fixture. This what we bought it for, this the value that it has gone down by at this point. We then have the total assets. This is going to be our check figure to see that assets equal liabilities plus equity, to see that the balance sheet is indeed in balance. That's going to be our asset side. So I'm going to go ahead and I'm going to compress this right now so we can focus in on the liabilities and equity component now. So there's our assets. Liability and equity should tie out to that same number as it does here. If we compress that, we say liabilities and equity is the same number. And the beauty of using QuickBooks is that it will always be the same number. The frustrating thing about using QuickBooks is that when we enter something that we think makes sense but puts us out of balance, QuickBooks will not let us enter it until we make a transaction that actually works and that it's in balance. And so that can be frustrating if we think we have everything right and we don't see why QuickBooks won't let us post an entry. Why won't it let us? Because it's telling us we don't want to let you make an error. We want you to keep posting something. So these two items, assets always equal liabilities plus equity. In order to do so, every transaction needs at least two accounts, and it needs to affect the accounting equation in such a way that this balance works. I'm going to expand this back open again. We've got the liabilities, the current liabilities, including the accounts payable. That's what we generally start with, and that's what we owe to our vendors. We've got the credit card payment. This is where we're going to track what we owe to the credit card company, Visa, MasterCard typically. Other current assets, these are things due within a year's time period. So we have a loan payable current portion, meaning we owe this loan within a year's time period. We owe that back within a year. Payroll liabilities, we owe our employees payroll liabilities, and sales tax payable, or possibly those being payroll liabilities being taxes that we owe on withholdings to the government. And then we have the sales tax payable, or this could be an accrual. It's probably an accrual. This is an accrual that we have a payroll liability. And then we have the sales tax payable here, and then we've got the total current liabilities. Then we have the long-term liabilities. These are things that are going to be due within a longer period than just 1 year. So this is a loan that we took out, and this portion of it is not going to be paid back within 12 months, but paid back in a period more than 12 months. And so that will be that item, and that's our total liabilities. It's very useful to have our current assets here and compare those, scrolling back up, to the current liabilities, or at least to cash, because this is an indication of will we be able to pay off our current debts. So we can't pay off the current debts with property, plant, and equipment very easily. We can pay them off more closely with our current assets, and even more closely than that with our basically our quick assets, meaning the receivables we expect to receive soon and our checking account. So comparing these liquid assets to those liabilities which we owe relatively soon, the current liabilities being due within a year, very useful calculation, very common calculation, a calculation that we ourselves should be looking at, and a calculation that when we get financing from a bank or when people look to invest are definitely going to be concerned with. So that's going to be that. And then we have the equity section down here. This is kind of the most confusing part of the balance sheet oftentimes, and in some cases the most important, meaning that when we are describing what's the most important number on the balance sheet, it might be easy for us to say, we might say, well, it's total assets possibly, or maybe cash. But really, if there's one number to say how the company is doing, what the company is doing, the value of this company at any particular point in time, it's the equity section, the total equity section, meaning, in this case, the 149,232.92. That's the value in theory of this company. And the way we know that is because it can be calculated. Note our double entry accounting system is assets equal liabilities plus equity. If we compress this again, assets equal liabilities plus equity. And this number is pretty useful to us, but this number is not very useful to us except that it's in balance. Other than that, this number doesn't tell me much more other than it matches the total assets, and therefore our accounting equation is in balance. This number is useful, but what's more useful than that is to readjust this accounting equation to assets minus liabilities equals equity. And that tells us that this equity section represents the assets, what the company owns, minus the liabilities, third party that the company owes to, equals the equity section, net value in the company, the value that we, as the owners, could realize or have value in, and we could realize it in cash if we were to sell the business. In other words, the total assets of 228,8956 minus the liabilities of 78,856.64 equals the net value of this company, the total equity section of 149,232.92. So in essence, this is the value of the company. Now we can't just go spend that money. We can't just go spend it or just draw it out, because most of our assets are not in the form of cash. We're in business here. We don't just hold things in cash. Cash isn't going to help us make money. What helps us make money is spending that cash and buying other assets that we're going to use to generate revenue. So a lot of our assets in this case are in the form of furniture and equipment. We're buying music equipment. A lot of our assets are typically going to be in inventory. We don't have a whole lot in the inventory right now. And then we've got the receivables. These are things that are assets, but they're not cash. They're part of the normal process of business, however. And therefore, if we were to liquidate the company and, for example, sell the equipment for in this case, 102,225, or whatever the market value is, that's what we think the value is, and based on our estimate, then we can take that cash and then pay off the current liabilities, minimizing this, or all the liabilities. And then once we pay off all the liabilities, we would be left with just the equity section. So I'm going to take this. So here's just the equity section. So assets minus liabilities equals the equity section. So what is in the equity section then? We've got a couple components. This is a sole proprietor, and therefore in a sole proprietor, we have what's called the owner's equity account. If it were a corporation, if it was a partnership, we'd have to break out this equity into multiple partners. If it were a corporation, we would have a retained earnings account and a common stock account. The reason those are different is because a sole proprietor is owned by just one individual, and we just have to really roll everything into that one account and understand that that account is going to be applied out to whoever owns the business. If we're dealing with a partnership, then we're talking about the net value of the business, and the two partners are going to have some allocation. We, in essence, need to allocate the net value of this business between the partners within the business. So we're going to have an equity section or a capital account for multiple partners. Then if we're a corporation, it's a bit different. The total equity, remember, is always the same. So no matter what type of entity you are in, all of this will apply in that where the total equity is the same, and that it is the assets minus the liabilities. But in a corporation, we're going to have to break out the fact that all owners have stock, and the stock is all equal. That's the point of a corporation. And therefore, what we're going to break out in the corporation is not by individual owner, but by what type of equity it is, meaning is it an original investment, the original issuance of the stock, which would be common stock, and then it'll have retained earnings, which is the amount of earnings that are retained over the process of doing business, which have not yet been given back to the owners in the form of dividends. So we'll talk a little bit more about that as we go through. So this is going to be our owner's equity. The main account this represents for a sole proprietor, both the initial investment and the accumulation of revenue over time, minus most of the draws, except for the draws in the current period. The thing that's kind of funny about QuickBooks is that it actually breaks out both the net income and the draws on the balance sheet for the current period. That's unusual, but it's kind of nice. So in other words, when we go to the income statement, as we will in a bit, we'll see that if we make the income statement for the same time period, meaning the year ended 12/31, January 1st through 12/31, then we'll see that we had a loss of 1,063.08. And so on the balance sheet, QuickBooks combines that. QuickBooks shows us that and it breaks out that component. A little bit unorthodox, but can be useful when we try to tie these accounts out. Then we've got the owner's draws, and again, that's something that's going to be on the balance sheet that oftentimes on the balance sheet would be just combined into the owner capital, but it's going to show us, in this case, the breaking out of what the owner drew out for personal use over the time period that we are given here, which is January 1st through December 31st. So this is money that was drawn out from the owner, reducing the total equity in the owner's equity account. So this is an example. This is just a quick overview of what the balance sheet is. I'm going to make it extended out here. This is what the balance sheet is, what it goes over. We're going to always have the standard balance sheet open. Whenever we go through problems, going back to the home page over here, we're gonna enter bills, we're gonna pay bills, we're gonna create invoices, we're gonna create sales receipts. All of those will have an impact on the balance sheet. And as we do those items, we're always gonna go back to the balance sheet, look at the end result that QuickBooks is generating automatically, and then drill down on some of this and see what we actually did, which is great. This is kind of like what we do in auditing, is that we start at the end product oftentimes and work backwards to see what is happening. So we can actually input data and then go back to the end result and drill back on that data. So we can see the data from entering the data to the end result, and we can see it from the end result and going back to, in this case, the point that we entered the data from the home page. That is very useful. We should be able to see, if we can see the process going from the data input point to the end product and back from the end product to the data input point. That is huge to understand. And if you work in a theory class, you may have an understanding of it with debits and credits. If you work with software, then you can get a better understanding of how to do that same concept with forms and how to get a better understanding of forms. So I'm going to close this back out, back to the balance sheet. And next time we'll take a look at the profit and loss of the income statement, and then we'll go ahead and do some customizations to the balance sheet.